In a world where financial markets shift with startling speed, few assets capture the collective imagination quite like Bitcoin, and today the leading cryptocurrency finds itself once again navigating turbulent waters as renewed volatility sweeps across the entire crypto landscape. Welcome to this urgent update from Crypto Hub, your trusted source for in-depth analysis of the digital asset ecosystem. As we delve into the latest developments, it is essential to approach these movements with the seriousness they demand, recognizing that behind every price fluctuation lie complex economic forces, institutional decisions, and global events that shape the future of finance. Bitcoin, long hailed as digital gold, is currently experiencing significant pressure, trading in a range that has tested investor resolve and highlighted the inherent unpredictability of this maturing yet still volatile market. The past several weeks have seen Bitcoin struggle to maintain its footing amid a broader resurgence of uncertainty in cryptocurrency valuations. As of late May 2026, Bitcoin hovers around the $74,000 to $77,000 level, reflecting a notable decline from its peaks above $126,000 seen in late 2025, and even from levels near $108,000 just a year prior. This downward pressure is not an isolated incident, but part of a larger pattern where the crypto market has turned volatile once more, erasing gains and prompting both retail and institutional participants to reassess their positions. Such episodes remind us that while Bitcoin has achieved remarkable milestones in adoption and legitimacy, it remains sensitive to macroeconomic headwinds, regulatory signals, and shifts in investor sentiment. At Crypto Hub, we believe in providing clear, factual insights without hype, focusing instead on the data and trends that matter for informed decision-making. To understand the current situation fully, one must examine the immediate catalysts driving this volatility. Recent data indicates that Bitcoin has faced consistent selling pressure, with prices dipping as low as the mid-$70,000 in recent sessions. This comes after a period of relative stabilization earlier in the year, where hopes for a sustained recovery were buoyed by institutional inflows and positive policy rhetoric. However, those expectations have been tempered by a combination of factors, including deleveraging in futures markets, where open interest has contracted significantly from earlier highs. In February 2026, for instance, Bitcoin experienced a sharp drawdown of nearly 19% in a short span, falling into the mid-$60,000 before partially recovering, a move largely attributed to rapid unwinding of leveraged positions rather than fundamental deterioration alone. Now, in late May, similar dynamics appear to be resurfacing, with liquidations totaling billions across the crypto space amplifying price swings. Delving deeper into the technical landscape, Bitcoin's price action reveals a market at a critical inflection point. Trading around $75,000 to $77,000, the asset has seen month-over-month declines of several percentage points, with year-to-date performance reflecting an 11% drop from its October 2025 highs. Analysts tracking these movements note that the cryptocurrency is confronting key support levels that have historically either held firm or led to further corrections. Realized volatility, while lower than the extreme levels of previous bear markets, has nevertheless picked up, creating an environment where sudden moves of 5% or more in a single day are becoming more common. This volatility is evident not just in Bitcoin, but across major altcoins, with Ethereum trading near $2,000 and other tokens experiencing even steeper drawdowns, underscoring the interconnected nature of the market. The total crypto market capitalization has faced headwinds, contracting as risk appetite diminishes amid broader economic uncertainties. One cannot discuss this renewed volatility without addressing the macroeconomic backdrop that exerts such profound influence on Bitcoin. Global financial conditions remain mixed, with persistent inflation concerns, shifting interest rate expectations, and geopolitical tensions playing central roles. In the United States, policy developments under the current administration, including discussions around Federal Reserve leadership and tariff implementations, have introduced layers of uncertainty that ripple through risk assets. Bitcoin, increasingly viewed as a macro asset rather than a niche digital token, responds sensitively to these signals. For example, fears of escalating trade tensions between major economies have led investors to favor traditional safe havens like gold at times, pulling capital away from cryptocurrencies and contributing to the pressure on Bitcoin prices. Furthermore, recent ETF flows have shown periods of net outflows, with spot Bitcoin exchange-traded funds experiencing significant withdrawals in certain weeks, reducing a key source of steady buying demand that had supported prices throughout much of the previous cycle. Institutional involvement, while a net positive for long-term legitimacy, has also introduced new dynamics to volatility. Large holders and corporate treasuries, such as those following strategies similar to MicroStrategies, continue to accumulate in some cases, but have also faced scrutiny when valuations dip, leading to speculation about potential selling. On-chain metrics reveal that long-term holders have been distributing portions of their holdings at an average rate of thousands of BTC per day, adding to available supply in an environment where demand has not always kept pace. Exchange reserves for Bitcoin have trended lower overall, indicating that many coins are being moved to cold storage. Yet the short-term trading supply remains sufficient to fuel rapid price adjustments during periods of fear. This supply-demand imbalance is further complicated by minor activities. With halving events in the past having reduced block rewards, miners are under pressure to sell newly minted coins to cover operational costs, particularly when hash rate competition intensifies. Geopolitical factors have added another dimension to the current market stress. Tensions in various regions, including potential conflicts affecting energy prices and global trade routes, have heightened risk aversion. Bitcoin's narrative as an inflation hedge or store of value is tested in such times as investors weigh its correlation with equities and other assets. During previous periods of market turmoil, such as those involving currency fluctuations or central bank interventions, Bitcoin has at times decoupled positively, but the current environment shows tighter linkages, where stock market volatility often drags crypto lower in tandem. The VIX index, a measure of expected market swings, has seen spikes that historically coincide with Bitcoin bottoms or periods of consolidation, suggesting that while pain may persist, opportunities for recovery could emerge once broader sentiment stabilizes. From a historical perspective, this phase of volatility is not unprecedented. Bitcoin has endured multiple cycles of boom and bust, with drawdowns exceeding 50% or even 70% in earlier years, only to reach new heights in subsequent recoveries. The 2022 bear market, for instance, saw prices plummet dramatically before the 2024 to 2025 rally propelled Bitcoin to record levels. What distinguishes the current situation is the increased institutional participation and regulatory clarity in certain jurisdictions, which provide a more solid foundation than in past downturns. However, the speed of modern markets, amplified by algorithmic trading and derivatives, means corrections can unfold with greater velocity. Traders referencing past patterns, such as those overlaying current charts with 2018 or 2022 timelines, suggest the market may still be midway through a longer consolidation phase, potentially extending into later 2026 before a decisive uptrend resumes. Predictions vary widely, with some analysts forecasting conservative ranges between $75,000 and $95,000 in the near term, while more optimistic models target $100,000 or higher by year-end if key resistances are broken. Examining the broader crypto ecosystem reveals how Bitcoin's pressure affects everything downstream. Altcoins, which often amplify Bitcoin's movements, have faced steeper declines, with many tokens down 20 to 40% or more from recent highs. This dominance of Bitcoin in market share, hovering above 50 to 60% at times, indicates a flight to perceived safety within the crypto space itself. Ethereum, despite its technological advancements and staking mechanisms, struggles near $2,000, reflecting challenges in maintaining developer activity and user adoption amid uncertain sentiment. Layer 1 and Layer 2 solutions continue to innovate, with improvements in scalability and transaction costs, yet these fundamentals are often overshadowed by macro-driven trading in the short term. Decentralized finance protocols have seen total value locked contract as users reduce exposure, while non-fungible tokens and other sectors experience similar pullbacks. This interconnected volatility underscores the importance of diversification and risk management for participants at all levels. Regulatory developments worldwide add layers of complexity to the narrative. In the United States, ongoing discussions around clearer frameworks for digital assets have provided some optimism, yet enforcement actions and legislative delays create periods of hesitation. Internationally, countries like China maintain strict stances on crypto activities, impacting global liquidity flows, while others in Europe and Asia advance with licensing regimes that could attract institutional capital over time. These regulatory shifts influence how exchanges operate, how stablecoins function as bridges in trading, and ultimately how capital enters or exits the market. For Bitcoin specifically, its fixed supply of 21 million coins positions it uniquely against fiat currencies prone to debasement, a characteristic that gains relevance during times of monetary policy uncertainty. As central banks navigate inflation targets and growth objectives, Bitcoin's scarcity narrative strengthens in the eyes of long-term believers, even as near-term price action tests their conviction. Market structure has evolved considerably since Bitcoin's early days. The rise of spot ETFs has democratized access, allowing traditional investors to gain exposure without direct custody concerns. Yet these vehicles have also introduced flows that can exacerbate movements when sentiment sours. Futures markets on platforms like CME reflect sophisticated hedging strategies employed by large players, with open interest fluctuations serving as a barometer for leverage levels. Options trading volumes provide insight into expected volatility, with implied volatility metrics sometimes signaling extremes that precede reversals. In the current environment, with Bitcoin futures showing moderated but still notable activity, the potential for cascading liquidations remains a risk that participants must monitor closely. Educational resources and analytical tools have proliferated, empowering more informed participation, yet the emotional aspects of investing, fear and greed, continue to drive outsized reactions. Looking at on-chain data offers a more granular view beyond headline prices. Metrics such as active addresses, transaction volumes, and whale movements reveal underlying health. While price dips, network usage in some areas remains resilient, suggesting real-world utility and adoption persist beneath the surface noise. Hash rate, a measure of computational power securing the network, has generally trended upward over time, indicating sustained miner commitment despite profitability squeezes. Difficulty adjustments ensure the blockchain's integrity, adapting to changes in participation. These technical pillars provide confidence that Bitcoin's foundational protocol remains robust, even as its market price navigates volatility. Long-term holders, often referred to as hodlers, have historically outperformed those chasing short-term swings, a lesson reinforced across multiple cycles. The psychological impact of these volatile periods cannot be overstated. Retail investors, many of whom entered during bull runs, face difficult decisions when red candles dominate charts. Media coverage often amplifies extremes, swinging between euphoria and despair, which can influence behavior in self-reinforcing ways. Professional traders and funds, equipped with sophisticated models, may view dips as accumulation opportunities, provided macroeconomic conditions align. At CryptoHub, our commitment is to cut through this noise with balanced perspectives, emphasizing that volatility is a feature, not a bug, of emerging asset classes. Bitcoin's journey from obscurity to $1 trillion market cap in roughly a decade demonstrates its resilience, but it also highlights the need for patience and thorough research. Potential pathways forward warrant careful consideration. Bullish scenarios hinge on several developments: renewed ETF inflows as sentiment improves, favorable resolutions to geopolitical conflicts, and accommodative monetary policy that supports risk assets. Algorithmic forecasts suggest possible targets around $80,000 by the end of May or higher in subsequent months, if momentum builds. On the cautious side, prolonged pressure could test lower supports in the $60,000 to $70,000 range, especially if broader economic slowdown materializes or if regulatory surprises emerge. Historical drawdowns of 50% or more have occurred, yet recoveries have followed as innovation and adoption continued unabated. Factors like quantum computing advancements, while posing long-term challenges, are being addressed proactively by the community, ensuring the network's security evolves. Ethereum's upgrades and the growth of decentralized applications further complement Bitcoin's role as the anchor of the ecosystem. Broader implications for the financial system are profound. As Bitcoin matures, its correlation with traditional markets evolves, sometimes acting as a hedge and at other times moving in sympathy. Institutional allocation to crypto, though still a small percentage of portfolios, is growing with endowments, pension funds, and corporations exploring exposure. This mainstreaming brings stability over time but also imports traditional market sensitivities. Stablecoins play a crucial role in providing liquidity and serving as on-ramps, with their peg mechanisms under scrutiny during volatile episodes to ensure they fulfill their utility. The entire crypto infrastructure, from wallets to custodians and bridges, has strengthened, reducing some operational risks that plagued earlier years. In reflecting on these dynamics, it becomes clear that the current pressure on Bitcoin and the accompanying market volatility represent not an end, but a phase in a larger story of technological and financial evolution. Investors are encouraged to assess their risk tolerance, maintain diversified portfolios, and stay informed through reliable channels. Education remains paramount, as understanding the underlying blockchain technology, consensus mechanisms, and economic principles separates sustainable participation from speculative gambling. At times like these, focusing on long-term trends such as increasing global adoption, improvements in energy efficiency for mining, and integration with traditional finance provides perspective amid short-term turbulence. Furthermore, community sentiment, often gauged through social platforms and sentiment indices, shows a mix of caution and optimism. While fear dominates headlines, dedicated developers and builders continue advancing projects that could drive future value. Predictions for 2026 range from conservative to highly bullish, with some envisioning new all-time highs if structural supports hold. Regardless of the precise trajectory, the decentralized ethos of Bitcoin ensures it operates independently of any single entity, offering a compelling alternative in an increasingly digital world. Challenges such as scalability, environmental impact, and accessibility are being tackled through ongoing innovation, positioning the asset class for greater relevance. As this update draws to a close, it is worth reiterating the importance of measured analysis in navigating these waters. The crypto market's volatility serves as a reminder of both its risks and its potential rewards. Bitcoin, under pressure today, carries the same revolutionary promise it has since inception. At Crypto Hub, we remain dedicated to delivering timely, professional insights to help you stay ahead. Thank you for joining us in this discussion. Stay vigilant, stay informed, and we look forward to bringing you the next comprehensive update on the evolving world of cryptocurrency. This has been Crypto Hub, signing off with a call for thoughtful engagement in these dynamic markets.